You probably clicked on this video because you're either holding 10x Genomics or you're thinking about holding the stock. Today we want to talk about why we're not worried that the stock has slid 68% since the beginning of the year, because we believe there's a solid company underlying the stock. So as we said, it's fallen dramatically, 68% since the beginning of the year, compared to a Nasdaq fall of 23% over the same time frame. It's always important to benchmark a stock, whether it's rising or falling, to see how that compares to a benchmark, in this case Nasdaq. Now, we check in with our tech stocks about once a year. We find that to be a sufficient cadence. So it's about time to check in with 10x Genomics. And today we're going to emphasize revisiting our original thesis to make sure that hasn't changed, and of course, survivability. Now, we'll start at the beginning in terms of the bull thesis, which is quite easy to understand. So you have about 40 trillion cells in your body, and we didn't actually know this. Not all share the same DNA. So we had assumed that all cells in the body have the same DNA, but they don't. And you can see here, this is a New York Times article in 2018 that talks about that. And then below that same year was a science piece that talked about how brain cells actually revamp their DNA, and perhaps that's the cause of Alzheimer's disease. So quite interesting stuff. And when we think about sequencing DNA, so we're probably familiar with Illumina, and they build the machines that allow you to sequence DNA. Well, they do what's called bulk sequencing, and they take a population of cells and sort of take the average from that population, and that's what they sequence. Well, single cell sequencing is just that. It's taking a single cell and sequencing it. So here are the steps involved. You isolate single cells from a cell population. You can imagine how difficult that is to do. And then you extract, process, and amplify the genetic material of each cell. Again, that sounds pretty difficult to do. And then you prepare what's called a sequencing library that includes the genetic material of the isolated cell. And then you pass it on to a next generation sequencing machine like the ones that Illumina builds. So that's pretty easy to understand. And you can imagine how difficult these tasks are to do. So quite a few companies have been dabbling in this space. Now, we took this collection of logos from a company called Decibio. They're a research firm that put out a piece. They've since withdrawn that, but it examined what they called the single cell revolution. And they were looking at firms like 10x Genomics and Berkeley Lights and Illumina, and seeing how they all interact and who the leader was. And they reached the conclusion that 10x Genomics was leading in terms of the technology they have to accomplish those steps that we talked about. And if you go to Illumina's blog, you can see from last year, they talk about how the 10x Genomics workflow interacts with Illumina. And they had this diagram which shows that you need to do all these preparatory steps and then finally do the sequencing using Illumina's machine. So we can see how a company like 10x Genomics complements Illumina rather than competes with Illumina. Now, here are the instruments that 10x Genomics produces, the consumables and software. So similar to Illumina, they have kind of that same sort of business model, very high margins because consumables are often high margin, and we use the same metrics to gauge their success. So number of machines deployed, things like what they call consumable pull-through. And this is a great metric to have because it shows that the machines are actually being used. If you can recall Berkeley Lights, they were doing something similar. They're dabbling in single cell tools, but the criticisms around that firm were that the customers who were buying the machines weren't using them. So this would have been a very useful metric to follow to see if that was indeed the case. And I'll just touch briefly on that. So we used to be shareholders in Berkeley Lights, and then we ended up selling our position around the time that that short report came out, because a lot of the concerns raised in that report we believe were valid. And on 80% of the report we didn't pay any attention to, but they had certainly raised some valid points, and it seems, at least until now, that that was the right decision to make. So for 10x Genomics, we want to make sure that they keep selling more instruments. So we have that top metric, cumulative instruments sold. We want to make sure that the instruments they sell are being used, and that bottom metric helps monitor that. Now, of course, it doesn't matter how many instruments they're selling or how much consumables are being used. It comes down to revenues. So here's a look at the quarterly revenue growth for 10x Genomics that we put on a simple chart here. You could see in Q2 2020, they took a dip, presumably because of the rota. And then also you can see this last quarter is somewhat problematic. They seem to have dipped. Now, when the company compares this past quarter, Q1 2022, they compare it to Q1 2021, and you can see there, those two bars, that this last quarter is slightly higher than the same quarter in the year prior. That looks better than being negative. But if you look directly from last quarter to this most, or the quarter before that, so Q1 2022, if you compare that to Q4 2021, that's a pretty dramatic drop in revenues, and that's concerning. So we came across this comment in the quarterly earnings 10Q, and it says that they believe revenues were negatively impacted by certain of our customers' staffing capacity issues, slowdowns, and this is a key here, general increased uncertainty around near-term operations. That's a concern because 75% of their customers are academic institutions right now. So if suddenly they're putting budgets on hold or rethinking their spending in the face of a very uncertain market, that is a concern. And they say here, we believe these impacts were particularly relevant for academic customers. So that's somewhat of a concern. Now, when we look at revenue granularity, so what we've done here is taken the last 5 quarters on the top table and broken down instruments versus consumables versus services. You can see here that between last quarter and the quarter before that, there's a significant drop in the sales of instruments and in consumables. So one of the reasons that 10x Genomics raised for this past quarter being less than optimal in terms of the revenue growth was a cold chain problem that affected European customers. So what happened is that some of the samples that customers were using had spoiled, and when they went to use those samples, only after doing their analysis did they discover that, and then they needed to troubleshoot the problem, figure out what it was, and fix it. And in the meantime, things were on hold. So you can see here we've taken last quarter and compared it to the previous quarter by region. And of course, Europe is down 40%. Okay, that's the cold chain problem. Fair enough. But then why is North America down 23%? And that perhaps has to do with the aforementioned slowdown and uncertainty with their academic customers. So the best thing to do would be to wait until next quarter. So they said they may still have a hangover from that cold chain problem that will manifest itself in the coming quarter. So we want to watch for that, and then just keep an eye on how this goes. In their latest earnings call, they were pretty optimistic that these problems would resolve themselves and that the second half of this year would be quite strong for the firm, and they reiterated their guidance. So we just need to see that that's in fact the case. Now, optimistically, there's quite a broad number of applications that the platforms the company has are being utilized across. And here you can see there was 3,300 different articles that have been produced using the tools that 10x Genomics produces. And this is a breakdown by type. So that's good to see. If it was a very niche focus, then that would be more of a concern, but there's a lot of diversification in how their platform is being used. And you can also see here, they actually have 3 platforms. So the flagship platform, Chromium, you could see here, has a number of solutions that it offers in this table. And then the last item in the table, Visium Spatial, That's actually a consumables product that Chromium customers use. So 10x Genomics talks about 3 platforms: Chromium, Visium, and then this third one, Xenium. So that's a new instrument, consumables, panels, software. That's an entirely new platform that's going to come out at the end of this year. And in their most recent earnings call, there were 23 mentions of the name Xenium. So analysts are viewing that as something that can potentially be a game changer for the company. Now, when you look at consumables, remember we mentioned Visium was a consumables only platform. Well, they actually combine those consumables with Chromium consumables, and most likely they'll do the same with Xenium. So you still have those same categories: instruments, consumables, and then services, which is a very small component. So, and this, I think, is representative of the research and development dollars that the company spends developing new equipment which their customers can use. Now, in the last quarterly call, they said their guidance was unchanged. That's very important. We don't pay too much attention to quarterly fluctuations. We're mainly interested in annual results. So we're expecting them to hit what they reiterated, their guidance of 600 million to 630 million, which would represent growth of 22 to 28% over the previous year. That's pretty strong growth. So that's what we're going to be keeping an eye on. Now, in terms of how the company's valued, we've taken their market cap and divided that out by annualized revenues. And of course, since they had that last quarter that was down, the simple valuation ratio goes up. And most of the firms we look at these days are all in the single digits. So it wouldn't be surprising if this coming quarter, they still have a hangover from that cold chain problem in Europe, and everybody freaks out and the price of the company dips even more into the single digits. So we don't like to look at things in terms of share price. We simply like to look at it in terms of market cap divided by annualized revenues. So the takeaway here is that if you're thinking about adding shares or you're thinking about opening a position, you'll probably want to use dollar cost averaging and not try to time the market. So you're never going to sell at the top and you're never going to buy at the bottom. But if you buy and sell slowly over time, then that helps reduce your market timing risk. Now, just to conclude, the Q2 2022 results will have the final impact of the European cold supply chain problem. And the firm talked about how they're increasing sales ramp up. So they're adding 100 bodies in 2022. Well, they have, based on our calculations, about 3 years of runway based on the $47 million that they had in operating costs last quarter. So they seem to be pretty well situated to manage through any sort of economic turmoil that may be coming up. And their high gross margins, upwards of 80%, certainly give them a lot of leeway. So from where we're sitting, we think that survivability isn't an issue. They appear to be maintaining their leadership position, and we have key metrics to watch for that. So now we just need to see that the company can hit their guidance for this year, the aforementioned 600 million on the lower end of that guidance, and we'll be happy with that. So we'll probably, as we do, revisit this firm next year to see how things are going. So please put your comments in the comments section. We'll address them there. Make sure to subscribe to our channel. And thanks so much for taking the time today to watch this video.